Welcome back. As you may know, new U.S. inflation numbers were published at 8:30 a.m. Eastern time today. They showed inflation both on a headline and core basis and on both a monthly and annual basis coming in hotter than expected in January. Let's talk about it, what it means to investors and ultimately your portfolio. John Zechner is with us now. He's chairman and founder at Zechner Associates. John, thanks for coming in.
Hey, morning, Paul.
What's your take on these numbers? We continue to see evidence of a strong U.S. economy.
Yeah, and the numbers were slightly hotter than expected. I think they're, the January numbers are always a little bit distorted, employment numbers, inflation numbers, and then people were a little bit worried what the California fires are going to impact that as well. But yeah, the core was above expectations and the headline as well. And clearly they're not, core is sticky around the 3% level. And, that's a long way, that final percentage point, to get it down to the Fed's target where they would continue to cut rates. So I think, the market is really anticipating at this point that, two cuts may not even happen this year, maybe one, maybe none. And it'll be interesting to watch Jerome Powell's testimony today. It could be a lot more than the one yesterday at Congress where, he's mostly talking about banking regulations and other things.
Right.
And really saying stay pat on rates.
Right.
And, I think there'll be more of the same today. But he has no reason to make a move at this point.
Right.
I mean, policy is tight by any definition. I mean, you got short-term rates around 4.3%. That's 1.5% real rates, effectively, even with inflation at 3%. You want to move it down to target. So it's enough that they don't need to raise rates from here, but the expectation that they would cut, that's really gone out the window, and that's a bit of a headwind for a stock market that valuations are effectively at all-time high, sentiment is very high, expectations are high, and you got a lot of exogenous factors sort of on the outside right now hitting you. So, I get it that the stocks are sort of just spinning their wheels right now, and averages haven't done much for a while. We're still in a bull market until proven otherwise, Paul. And the earnings are probably justifying it to a degree, but there's a lot of things to make you want to stick your head in the sand a little bit or get pretty defensive in what you hold. And I don't think it's the time to be putting on what you call beta or aggressive risk or overweighting stocks to any degree.
Is the rate outlook one of the things that makes you cautious? The market is now pricing in one single 25 basis point rate cut from the Fed, and the market believes we'll have to wait until December the 10th before we get it.
Yeah, I don't think that makes a huge difference yet. I think that'll slow the economy down at current rates enough to sort of get inflation down towards target and maybe not put the U.S. in a recession, which is good. And Canada, as we know, is in a totally different situation. Our rates are dramatically lower than the U.S. now and going lower. No, I think the bigger issue is for Canadian investors, what's going on with these tariffs. This is huge. And, there's some idea that, maybe Trump is just jockeying for position or something like that, or this is a negotiating tactic. I mean, it's only like 3 weeks ago since he got inaugurated, and the domination of the press every single day of his vacillating on these points has everyone concerned. But the tariffs are real. And I think Trump needs them to offset, what he wants to deliver, get through on the tax cuts. So I don't think the tariffs are going to disappear. So I think people should, it may not come in exactly like you're saying. There may be some negotiation, but I don't think we should kid ourselves. Canada and the rest of the world are going to be facing higher tariffs or tariffs going into the U.S., and I don't think that he's going to back down on that one.
You don't think, then, that tariffs add significantly to U.S. inflation and conflict with Donald Trump's pledge to make life more affordable? In other words, to put downward pressure on inflation in the U.S.?
Oh, they do. I think they absolutely do. And I think that's another headwind for the market. Like I say, exogenous factors that have you a little bit worried. In the end, they're absolutely inflationary, and you don't know who absorbs them. If the companies absorb them, that's going to cut into their profit margins. If they try to pass them on to consumers, that's going to go into a higher inflation. So there's no real win there, except I don't see him backing off for the simple reason that from a budgetary point of view, you've got to come up with some tax increases somehow to offset the fact that they want to go ahead, extending the Trump tax cuts and other things like that. And they're already got a big deficit issues. And probably, one of the simplest ways to do it is start, tacking on these tariffs across the globe from U.S. trading partners.
the Canadian economy is already slowing, and you don't sound very optimistic on where it's going in light of the looming trade war.
Well, it's sort of hard to, Paul. I mean, you know, when you look at this on a realistic basis, I mean, yeah, look how intertwined our economies are. If they're not going to back off on this, I mean, you know, the auto industry is the most at risk because of the transborder traffic. You know, Canada, Mexico, on top of the U.S. But you know, the steel industry. I mean, anything in the industrial product side gets hit. Financials are at risk because they do all the lending to this. That'll impact economic growth. So, you know, you can find areas that are less impacted, you know, the telecom industries, other domestic industries, maybe small caps do better. You can find holes to hide in. But, you know, as a general rule, yeah, this is a big risk to our economic growth. And ultimately, the stock market is all about earnings, which are tied to economic growth. So that's, you know, even with lower interest rates here, it's a big headwind for us that I don't think is going away.
You mentioned the auto industry. There are estimates out there that the price of an automobile in the United States may rise by an average of $3,000 because of the higher price of steel and aluminum driven by tariffs. You don't think that will put pressure on Trump on this issue?
Well, I think all of this is going to put pressure on Trump ultimately. And, you know, the Trump, you know, modus operandi is typically that's going to be somebody else's fault, whether it's Biden's or Canada's or whatever. So, you know, sort of talk the way around it. But, yeah, Paul, I just think there's a lot of headwinds on all sides of this going ahead. And I don't think, you know, his agenda that he sort of got elected on, I don't think you can implement that fully to any degree. So there's going to have to be misses on promises, you know, whether they can sell that or package it differently, I don't know. But in the interim, you know, the markets seem to be assuming all the best, you know, less regulation, strong economy, interest rates coming down. It's not all going to happen. And, you know, Trump can try to talk Jerome Powell into reducing rates and all of that. You know, that won't happen that way. Even if at some point he gets rid of him, he's probably not going to reappoint him next year. So, you know, the market is the ultimate determinant. The market will decide where interest rates are going, not the U.S. president.
That is John Zechner.